Happy Tuesday. I've got a little Fox News on my left over here on the wall, and did not realize I'm not a historian by any means, but I guess today is the 79th anniversary of D-Day. So just shout out to all the families out there all over the country that at some level, someone in the family tree served our great country, if you will. And so anyway, just want to throw a shout out there. Welcome to Tax Tip Tuesday, Shey's Way, where we're going to talk about everything protection, investment, tax related to your financial endeavors. Been having a number of meetings that I'm going to talk a little bit about today. Going to share my screen a couple different times to hopefully maybe shine some light on why we talk about some of the strategies, whether it be an insurance strategy or investment strategy, of why we talk a lot about them and how they fit into your overall, I guess, financial portfolio. That if you're listening to myself or Brent Kessler or Chris Noggle or some other people out there that are sharing information that I would say runs against the conventional wisdom of financial planning or retirement planning, estate planning, legacy planning, whatever you want to call it. If you're following the conventional wisdom, then I believe that you're wrong, that you're just following the wrong people. It's the blanket that I say when I'm in my one-on-one meetings with people I have working relationships with all over the country. When I say, if you're participating in the traditional 401k plans or traditional IRAs or SEP and Simples, and you're just doing what maybe an advisor is telling you to do, I just have a belief that that's the blanket that the country's or that the government has pulled over the country's eyes in regards to using conventional retirement accounts for your overall plan. I believe that they're in the best interest of the government of the United States. They're not in the best interest of you as the end user, and there's just better ways of doing it. So with all that said, remember, I'm just going to share what I believe is the truth, the facts. Feel free to push back against me. You're not going to hurt my feelings by any means. And if there's someone out there that you're listening to or tuned into on some level, then feel free to share. This is an open forum by any means. And, we'll just continue to talk through it. Hopefully I've gotten quite a bit of positive feedback regarding the content, if you will, that is shared here. So we'll keep doing that and hopefully continue to sharpen our saws. My little disclosure here that I read every week, the material shared here is it's a webinar. It's prepared for informational purposes only. It's not intended for you to go out and invest your money in some particular vehicle. It shouldn't be relied upon as tax, legal, or accounting advice. You should certainly consult your own tax, legal, and accounting advisors before you engage in any type of transaction. If you don't have those people, feel free to reach out. I can certainly put you in touch with, I would say, quality CPAs or quality estate planning attorneys that I've worked with either in the state of Florida or outside the state of Florida. So again, I guess that's the disclosures for the day. So again, Mark, appreciate if you have questions, please throw them into the Q&A, not into the chat. I will, I'm going to try to grab my information for you guys and throw it into the chat real quick in case you don't have it. So all of these webinars are recorded, then they're edited a little bit, and they're up on my YouTube channel at Brian Shey. You can also go to sterlingwyatt.com and go under the podcast or webinar panel, if you will, where you can find information there. And I see a number of names that I've met with personally that have engaged with me on some level. And hopefully that's a good thing on your end, because it's been a great thing on my end. Hopefully we can continue to all get better at what we do. So with all of that said, I want to share a couple different things today And if there's something that I share, some of these things are out of PowerPoint presentations that I've done at some point in time in my past. One's an article that I wrote at some point in time. I really can't remember the year that I wrote this article, but I'm happy to send any information. If if I share something in a PowerPoint or whatever, and you want it, just somehow email me. It's my email is Shey@sterlingwyatt.com, but feel free to reach out. I'm happy to send anything that's not going to get me in trouble to anyone, which I don't think anything's going to get me in trouble. So anyway, where we at? We're at June 6th at 1:09. So hopefully everybody's having a good week. Wow, it's June. Almost half the year is gone. Just food for thought. If anybody had any messages, today's Tuesday. I'm leaving Thursday to head down to the Bahamas. Going to spend some time with the good people from One America. I think I'm going to be down there with Brent Kessler, Chris Noggle, and a couple of their team members. So looking forward to spending some time with those guys. Haven't seen them in a while. And so if anybody's talking to those guys, tell them I said hello, and looking forward to spending some time under the sun. So here's a little slide that I use in a number of presentations. I'm trying to move things out of the way so I can actually see the title of it. I think it has something in income. I've got stuff all over the place, so I can't really see it. But basically, I use this slide to talk to people regarding where money comes from and then how taxes and surcharges are going to affect you in this area. And I think this is, I don't know, maybe slide 30 in a presentation that I've done. The name of the presentation, I think, is actually Tax-Free Retirement Income, based off of the book Power of Zero, written by David McKnight. Always want to give him credit for the book. I didn't write the book. If you haven't read the book, most people, know that I'm a huge believer in the book Power of Zero. Just about everything I do personally is based off that book, and my financial practice is also probably 90% in line with the teachings in that book. When you think about money and where money comes from, or the types of money. So we got wage and income. So you have an ordinary income tax. If you don't live, I happen to live in the sunny state of Florida. I'm in Gainesville, Florida. My mom and I would go Gators. But you've got ordinary income tax, you got state income tax, you got Medicare surcharge, Social Security surcharges that all affect, if you're working for a living and making money. And then you've got stocks and bonds and, the different surcharges. Let me get rid of my face because it was covering up the 3.8% excise tax, which, I call that the Obamacare surcharge, where he brought that in against us on our stocks and bonds. And again, you still have your Medicare premium surcharges that you have to pay on that. And some of the reason that I bring this up is because it's not talked about. It's you hear me say it's not about how much money you make, it's about how much money you keep. And then in addition to that, how taxes, which in my humble opinion are the number one inhibitor of wealth in this country. So, then you can start using mutual funds and CDs and pensions. And pensions are almost, those things aren't even around anymore. CDs. Again, I'm not a huge fan of CDs because if you know anything about using permanent life insurance with a mutual-based company that pays a dividend, then you can put your money through the door of a life insurance policy and have so many more benefits than going down to the bank and putting in a CD and getting it locked up for a period of time with an inferior interest rate that you're still going to end up having to pay taxes on. So not a big proponent of CDs. And the reason that I'm sharing this slide, the big reason, and as I was getting prepared today, I kind of wrote a couple things down on sticky notes for me. And I'm sharing this slide because if you jump on any of Chris Noggle's information or webinar stuff, we're always talking about that mystical thing that nobody ever wants to talk about called life insurance. And there's a reason. And I want to share that with you because it's important for you guys to understand, or for anybody to understand, it's not like we're down, like I'm down here in Florida, or Chris is up there in Buffalo or wherever he's at running around the country, that we're just beating our chest telling everybody, to go out and take every penny that you ever have and throw it through the door of a life insurance policy, because that's not what we're saying. But I'm sharing this slide with you guys because I want to be able to say, number 6, if you want to start using traditional IRAs, you're still going to have to pay your income tax on that. And then you think that it's your money, but if you're under the age of 59 and a half, then you can't go get your money without paying a penalty. You've got your 10% penalty. You still have excise tax. You still have Medicare premium surcharges and Social Security, and it still counts as provisional income, which I used to know the page number in Power of Zero that talks about something called provisional income. And if you don't know what that term stands for, read the book, ask Google, and they will talk about provisional income. And what I will tell you is provisional income is the deal that Ronald Reagan had to make back in, I believe, 1986, 87, somewhere around there, where, as you probably know, in Washington, D.C., you're not going to get anything done without making a deal. And Reagan cut the tax rates at that time. I think the highest was 70%. He cut it down to 28%, and the low became 15%. Well, he didn't get that deal done without a handshake and maybe a bourbon and a cigar in the dark room. So provisional income was created, and that there are areas that fall under provisional income, which most of the sources that you're going to be pulling money from, either in retirement or in your later years, maybe not retired, will count against you and fall under provisional income, and therefore you have to pay taxes on it. When you think, again, going back to my slide that I'm sharing, and I apologize, I'm a little all over the place, 1 through 6, notice that none of them are in column I, so none of it is tax-free. You've got to start dealing with number 8, which, hold on, I got to click on the screen again. You've got to start dealing with, number 7, Roth IRAs. So again, I have another slide that talks about when the traditional IRA was created, which I'm going off memory. I don't know, maybe 1971, 76 was when the traditional IRA was invented. Back in, can't remember when Ted Bennett invented what we all know as a 401k plan. It's a different slide, but it wasn't until 1997 when Congress or the government invented what we all know as the Roth IRA. And immediately when they invented it, then all of the rules and regulations and restrictions came in play regarding the Roth, and it's very difficult to use. And if you make a little bit of money for a living, then you get phased out pretty quickly from being able to use a Roth IRA. And even if you can use it, then you can only put $6,500, maybe $7,000 on an annual basis, and therefore really you're not going to be able to put away a tremendous amount of money towards retirement through a Roth when it's only $6,500 or $7,000 a year, and there's a whole lot of people or population that cannot even use it. So, however, if you believe marginal income tax rates are going to be higher in the future than they are today, then it doesn't make a lot of sense for you to be using traditional IRA accounts or a traditional 401k plan if you believe taxes are going to be higher later. Why would you defer paying taxes today to pay them later on in life when you believe they're going to be higher? And before anyone throws out there, well, we'll be in a lower tax bracket whenever we retire or whatever it may be. Again, I just believe that that's the blanket the government's pulled over this country's eyes, where if you do something pretty cool between the ages of getting out of college and getting into your late 50s or early 60s, and you put some money away, the chances of you being in a lower tax bracket at that point in time are very, very small. The second, number 2, who sets the tax brackets? You don't get to set the tax brackets, the government does, and therefore we have to play by their rules. Number 3, all of the tax deductions that we all get to take part of when we're raising our children, when we have mortgages, all of those different things, once you get into those later years, into your mid 50s, low 60s, whatever, then you're losing a lot of your tax deductions. So everything, the deck is stacked against you if you believe you're going to be in a lower tax bracket later on in life when you retire. Again, all of that rolls into number 7, that if you can use a Roth, if you can use backdoor Roths, run the tax calculations. There's no free lunch if you're going to convert from traditional over to Roth. You got to pay the piper. But if you're using tax strategies, then there's a very good chance that you can get down into that 20% or even below 20% and do those conversions in those years. So as you guys think about 7, 8, 9, and 10, the reason I wanted to share this is because you've got to get into the Roth environment, the HSA environment, the long-term care type of policy environment, and then that thing called permanent life insurance is down there in number 10. And notice that all of them get you into column I. For me, that's the reason that I talk about using permanent life insurance as a small portion of your overall portfolio allocation. And I'm going to share a couple other things today with you. I would be remiss if I didn't say this. I talk about permanent life insurance in a much bigger picture than just infinite banking concept or bank on yourself or using it for that strategy. I'm going to be very blunt. I believe that you need to look at it from a larger picture also. If all you're thinking about doing is buying a permanent life insurance policy to use it as a infinite banking concept or bank on yourself, then that is very narrow-minded. And that is there's a far greater population of people that need to be using permanent life insurance for many other reasons than just to bank on yourself or to use it as a lending mechanism to earn compounding interest. Does it do all of that? Sure, it does. But I'm going to share a little bit more on that in a minute. I just want to say that you need to open up. Don't put the guardrails on your eyes and just look at that as only infinite banking concept or banking on yourself or whatever it may be, because there's far more reasons to be using that strategy or that tool in your overall portfolio allocation. Again, that's just a little chart that I use to show, how do we get over into column I, when it comes to taxes. That's where, that we want to try to get to. Here are the 4 principles and values that drive me in everything that I do regarding working with people. First and foremost, I have a very deep belief that children deserve to have a future. God forbid mom and dad are no longer around to provide for them. Number 2, your financial accomplishments, my financial accomplishments, they should be preserved. They should transfer within our family. And I don't believe the government of the United States should get a penny whenever I pass away. Number 3, after spending 30, 40, 50 years of our lives working for a living, we should all be able to retire with dignity. And if you don't believe in retirement, like I don't, it's a matter of, being able to mow your grass at any point in time that you want, or lie around the pool, or take a vacation, or whatever. I enjoy working, so that's a little bit of a different definition for retirement for me. But we should all be able to retire with dignity. Number 4, if you're a business owner or work for someone who owns a business, I have a deep belief that a business should survive the death of the business owner. Why are those my core values? Number 1, children. Children do not have a voice in the decisions that affect them. My children have never jumped up in my lap and said, Daddy, 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 love you more than anything in the world. But if something happens to you, have you done everything that you could possibly do to make sure that we don't ever have to move, that the colleges are paid for, that the mortgage is paid for, and that, my wife and children are going to be okay if I don't come home? Number 1, if you're buying permanent life insurance to use as an infinite banking concept and you don't have the death benefit to take care of your family, then you're wrong. Then you're doing it for the wrong reasons. I just want to share that because I'm working on a case right now, and the people have one idea of why you should buy life insurance, and they're missing about 4 of them. So I just want to share that with you. Again, Q&A, throw it in there, chat, throw it in there. You want to yell at me, you can yell at me through the chat or the Q&A also. So that first value of taking care of your family has to be, that's the protection component of your overall plan. And I've talked about mature simplicity, protection, investment, taxes. Got to lay the foundation of protection before you move into investments. And taxes play a role in both. Number two, your financial accomplishments should be preserved, transferred to your family, and not to the government of the United States. There's no better way, in my opinion, to transfer wealth across generational lines than through the door of a life insurance policy. The government did not create the product. The insurance industry created the product, and therefore we don't have to play by their rules. Number three, you should retire with dignity. I know there's at least one person on here that we've talked about that they reached out regarding One America's product, the asset-based long-term care. When I start meeting with people in their mid-50s, early 60s that have accumulated wealth, the question becomes, do you ever believe you're going to spend through your estate? And for the most part, most people say no. No, there's really no way that my wife and I are ever going to spend all of our money. And then I will respond with, I would agree, after I get to know them a little bit, with the exception of some type of catastrophic health event that does not kill you. So if you haven't taken that piece of the, that piece of off the chessboard, if you will, then you haven't transferred that risk. And whether or not you've accumulated 500,000, 5 million, or 25 million, if you have not transferred the risk of having some type of catastrophic health event, you can plow through an estate in a very short period of time. And for anyone out there that has had any experience with a family member or a friend with a family member that has had some type of catastrophic health event, stroke, nursing home, assisted living, home health care, whatever it may be, people can blow through a very large sum of money in a very short period of time. So that's one of the areas of, and there's nothing, I'm married with 3 boys. My boys are 20, 17, and 12, and I don't want any of them to ever have to bathe me, feed me, clean me, put me to bed, get me out of bed, put me on the toilet, take me off the toilet, whatever it may be. There's nothing dignified about having your children do that. And I don't get into the statistics on my webinars, but and I don't have a daughter, but for those people out there that have daughters, statistically, it is the daughter and it's the oldest daughter that ends up taking care of family members. So we can get into the stress and all of those different psychological effects that affect family members when someone hasn't planned appropriately. And then the last thing, I mentioned that if you're a business owner, a business should survive the death of a business owner. Who doesn't have a voice in the decisions that affect them in the working environment? And the answer is the employees. So has the business owner made responsible decisions to make sure that the employees of that company continue to work, continue to have livelihood, and continue to be able to prosper for their families? God forbid something were to happen to the business owner. So those are the 3 core values, kind of commonly held values that drive me in the decisions that I make. And what's interesting about that is that you'd be hard pressed to go out there and find many people that don't believe in those 4 commonly held values. The reason that, again, I shared that one slide is to bring you sort of full circle of why do we keep talking about that thing called permanent life insurance? And notice that I call it permanent life insurance because I'm not going to get into we get into conversations regarding, should you be using whole life? Should you be using indexed universal life? Should you be using universal life? Should you be using variable universal life? Should you be using variable adjustable life? And all of those different things, every one of those are permanent life insurance. It's just a permanent type of product. And this is probably a good point for me to get in. Don't get into sophisticated confusion. Number two, treat your life insurance person with the respect that you would give your doctor or your attorney or your CPA. And I share that with you because as human beings, we implicitly trust our physicians. The physician tells you to, hey, you have a rash on your backside, you need to take this pill, I'm going to write you a prescription. Go to your convenience store or your grocery store and pick up the drug and you immediately take it. And very few people would even question that. You implicitly trust your physician. You implicitly trust your attorney. Attorney says this is how we're going to defend you on a case or whatever it may be, then you're going to go along with it. So what's remarkable is as I work with different people all over the country for 25 years, there's a question about this or a question about that, or we can't have a meeting, or we're going to do something this way, not that way. And for whatever reason, there's a lot of questions about that. Most of the people that are working, at least that I work with, work at a very high professional level. And the questions shouldn't be real difficult. I'm just going to leave it at that. This is an article. I can't remember where I put this article or why I wrote it, but I'm happy to send this out. Let me just get through the article here a little bit. Permanent life insurance offers a combination of death benefit protection, cash value accumulation, guarantees, and income tax advantages that differentiate it from most other types of financial products. Permanent life insurance policy can be versatile financial asset. It can be a versatile financial asset, not a debt, that may help you effectively address different financial needs during various stages of your life. Consider some of the ways that a permanent policy might help meet different financial needs or achieve your long-term financial goals. And then I'm going to get into the bold. And I don't know if you can see the mouse or not, but protecting your value as a provider. Number one, life insurance is an effective way to help protect your family or business against economic loss. If I don't go home tonight because the drunk driver runs the stop sign, then my wife and my children deserve to continue living the lifestyle that I've provided for them for the last 30 years. Therefore, the protection component of your overall plan must be first. And I say that because it's fine to be thinking about banking on yourself and infinite banking concept and all of that stuff. But if you don't have an adequate amount of life insurance to continue to allow your family to continue living the lifestyle that you've provided for them, then you're doing a disservice. And one of the things that I read every week when I read my little monologue thing there is that I'm going to, or I think it's actually coming out, it comes out in the invitation to the webinar, is that I'm going to press you regarding aligning your values with your actions. And as human beings, we're all in denial of our mortality because that's the way we were built. So denial is at the root of all of the reasons that people don't do this stuff. But your values, all of us that have children, we would do anything within our power to take care of our children. And then somehow along the line, our actions run contrary to our values. And I've spent the better part, Mike, I'm going to get to your Q&A here in a minute. I've spent the better part of my life, 25 years professionally, showing people how to align their values with their actions. And, a lot of times I say, I'll use me. If you meet me at the coffee shop and I tell you I love my wife and my children more than anything in the world, and I would do anything for them, but on Friday night, you see me running around downtown, with some other lady, well, that's my actions not lining up with my values. Well, that one's easy because you see it. But if you haven't properly protected your family, then I'll just be honest with you. Don't talk to me about an infinite banking policy or a bank on yourself policy when you haven't done the first step of any financial plan, which is providing the protection component for your overall future of your family. So it'd be smart to get a separate policies, one for IBC and for cash accumulation and one for death benefit term. Without a doubt, that's certainly one way to go. Have no problems with that at all. Because if you're overfunding or if you're funding your cash value accumulation policy and you've checked all the boxes, it's a mutual company, it's a non-direct recognition whole life policy, that continues to pay a dividend, that's a company, AAA rated company. You've checked those 3 or 4 boxes. And if you say, hey, this policy, it's going to serve as my IBC contract, got no issues with that. But go buy that term policy also and put it in place. By the way, I would do it all at the same time because there's no reason to go through underwriting twice. And but that's definitely a way to think about it, Mike. Very, very good. No issues with that. Obviously, if you're buying term, it's not an asset, it's not accumulated any value. However, you've done the appropriate thing and you've lined up your actions with your values of taking care of your family. So have no problem with that at all, Mike. Going back to the article that I'm sharing with you, permanent life insurance is a source of cash or credit. The cash value that a permanent policy accumulates is much like the equity that you build in a home, and it can be additional financial resource during a time of need. We've all heard the Disney story, the JCPenney story, the people out there that were entrepreneurs that used their life insurance policies to fund something that they were trying to do in their life. And you could even ratchet it down and just say, well, most people, you should be carrying 6 months worth of cash as an emergency reserve account. If something were to happen to you, you could use your permanent life insurance policy to do that also if you have cash value that has accumulated inside the policy. And it just popped into my head, and I'm just going to share it with you. I'm sharing this with you because I want you to understand, why do we keep talking about that thing, permanent life insurance? And it's because it checks so many boxes that most other financial vehicles don't check. So the value of a life insurance during retirement. I love this one. People often assume that their need for life insurance ends when they stop working. That's the story of the business owner. I don't need to buy permanent life insurance because my business is worth 20 million. The guy who is in the stock market. I don't need to buy permanent life insurance because my stock portfolio account is worth 20 million. The problem with that is, who's going to buy your business? What's the tax consequences going to be for the business? And how long is it going to take to sell it? It's the same thing with the other guy, stock market. Actually, there's no way this ever holds value when it says people often assume that the need for life insurance ends when they stop working. Well, go find someone in their deathbed and when they look up at you and say to them, if you could have $1 million or $2 million or $5 million or $10 million to transfer within your family, whether it be your children, your grandchildren, or anyone else, would you want that opportunity? The answer is always going to be yes. So so the rest of that is, if you select a permanent policy that is paid up, no more premiums due at the time of your retirement, the life insurance protection can provide additional financial security for your spouse or partner during retirement. And I share that with you because I'm working on a case right now, and and I'm being asked to compare apples to oranges, where if anyone's working with me, most of the contracts that I design are paid up in 10 years or paid up in 20 years. And prior to age 65, most of the time, or 70 at the latest. And there are people out there that are paying their premiums into their 80s and 90s and 100s. And there are some people that think that makes a lot of sense inside of an IBC policy. I happen to have a different belief in that. Let me work into my 50s and 60s and 70s, and I'll make so much money that I don't ever need life insurance. Well, you just missed the number one most important reason to do it, and that is taxes. Try transferring a business, transferring an IRA, transferring a 401k plan, transferring a brokerage account, transferring an investment account. Try to transfer any of those types of assets across generational lines, and I'd be hard pressed for you to show me how the tax consequences are going to be better in that environment than through the door of a life insurance policy that transfers tax-free across generational lines. Number 4, permanent life insurance as a source of supplemental retirement income. Today, many people are realizing that the traditional sources of retirement income, such as Social Security, employer-provided retirement plans, may not provide enough income to maintain their standard of living when they retire. Permanent policy may be tax-efficient way to accumulate additional funds to help supplement your retirement income. Remember, you've got money in a left pocket, money in your right pocket, and the money out of the left you have to pay taxes on, but the money in the right you don't. and that year the government happens to put you in a very high tax bracket, then where are you going to take your money from? The pocket that you don't have to pay taxes. Conversely, 2 years later, the government may put you in a very favorable tax environment. And now instead of pulling money out of a Roth or a permanent life insurance policy, tax-free, you go back to those retirement accounts or those other accounts that you have to pay a little bit of tax on, and that's where you take the money. It's not rocket science. My entire philosophy with my clientele is basically put you in a position, in a pair of pants, where you can pull money out of multiple pockets based on what the government is going to do to you that year. It's that simple. Lastly, permanent life insurance is part of your wealth transfer, which I just talked about. But if leaving a financial legacy for your family is important to you, there are steps that you should take to help ensure that what you leave behind will pass to your loved ones in an orderly and efficient manner, like tax efficient as possible. Life insurance is an effective way to provide a financial legacy for your family. The policy death benefit is paid directly to your beneficiaries based on your wishes, tax free. So I share all of that, or share that article. And again, you may be thinking about the article saying, wow, it's really not that good of an article. But if I could share that with you on a one-on-one basis, that's fine. I'm happy to do that. Okay, so because as I continue to start working with people, and if you believe in this philosophy regarding staying in, instead of working in sophisticated confusion, but work in mature simplicity. Well, what's mature simplicity? Mature simplicity is, hey, you don't need Advil at the end of the meeting, and I don't need Advil at the end of the meeting, because it's just a simple, it's a simple strategy. And when I talk about considering using a permanent policy as part of your overall financial strategy, I say it a little bit differently nowadays. I think this article is maybe 10 years old, but I have a deep belief in using a small sliver of permanent life insurance inside your overall portfolio allocation. And I said it to a gentleman the other day that when you peel back the layer of a whole life insurance policy, it's basically a bond portfolio. And think of it this way. If you called up some type of money manager type person, notice I'm not saying me because I don't want to mess with compliance, but and said, hey, I want to give a money manager $100,000 to invest. I'm going to make the math easy. Well, that money manager would not take $100,000 and put you all into stocks and equities. They would come up with some percentage, maybe 80-20, maybe 70-30, maybe 75-25, maybe 60-40. Depending on age, depending on, are you a risk taker? Are you conservative? When you think about the pie chart that you're looking at, almost everyone has some type of retirement account. Most people have investments. Most people, at least that I'm talking to, have real estate. I work with a lot of physicians, a lot of people that own their own business. And when I start designing their overall portfolio, I'll say, well, doesn't it make sense that you would use a small sliver of a permanent policy in your overall portfolio allocation? And when you think about all of the benefits that permanent life insurance have, then I think you're going to struggle trying to figure out what would ever cause you not to use a small sliver of that strategy. So when you look at it that way and you understand that the underlying investable assets in at least whole life insurance is basically a bond portfolio, then think about it. If you are going to invest $100,000, 10, 15, 20% of that may be in a bond portfolio. Well, why not use that 10 or 15 or 20% of your investable money and shove it through the door of a life insurance policy? Because the underlying assets are the same. Here's the difference. You don't have to pay the taxes. You're not going to get a 1099. It has a death benefit to it. You have access to all of the money, most of the money. God forbid something happens to you, takes care of your family. The IRR, the internal rate of return, especially in the early years, is through the roof, hundreds and hundreds of percent. Now, you may not be around, you may have died. However, when you look at all of the different features that a permanent life insurance policy offers, you're going to be hard pressed to explain to me how that doesn't fit into your overall portfolio allocation. And I'm going to round this up here in a minute. And if you're working with some sort of advisor out there that you rely on to make important financial decisions, and those advisors or that advisor is pushing back on using life insurance as a strategy inside your overall portfolio, go ask them to defeat it. Don't go ask your life insurance person to do some type of comparable to putting money in an investing account, rather than using life insurance. Okay. It doesn't hold water. And what I've found over 25 years of doing this is everybody wants the life insurance person to win the battle. Go ask the other guy to defend it, or the other gal to defend it. Certainly not a pitch. If you want some additional information, feel free you can go to my website. You can schedule a 30-minute touch base on my Calendly link. My calendar is available to everyone on Tuesday, Wednesday, Thursday. Tuesdays outside of this hour that I'm doing this. Here's a question. Can you kindly provide an example of the product you are speaking about? Yeah, David, pretty easy there. I shared this slide a couple of weeks ago, so I didn't have it today. But when you're thinking about using permanent life insurance as a strategy in your overall portfolio allocation, then I'm going to advise you to use, here are the boxes. I'm going to advise you to use a mutual-based insurance carrier. Mutual, meaning not stock owned, not being traded on the stock market, mutually owned. So the company is owned by the policyholders. Number two, mutual owned company. And I'm going to advise you to use a whole life insurance policy. And you go Google whole life and you're going to find a million articles are going to tell you that right down there next to the devil, it's the worst thing in the world. And then you're going to find another million articles that are going to tell you that it stands the test of time when it comes to interest rates or the environment or the economy or the world that we live in. You're going to find a million articles that tell you that whole life insurance has absolutely stood the test of time. So mutual company, whole life insurance. The next part is a mouthful, and I can certainly educate you on a one-on-one basis, but you also want to use a life insurance company that is selling whole life insurance as a strategy that is what is called a non-direct recognition whole life product. That's a mouthful. Non-direct recognition whole life. And in my opinion and to my knowledge, there are 3 companies left in the United States of America that market that product. And they are Mass Mutual, Lafayette Life, and One America. And I'm a One America guy. I mean, I'm not a captive agent with One America. I just have a deep belief in that organization. And then probably 4th or 5th, whatever number I was on, I think it was 4th, that they pay their dividend. And most insurance companies pay their dividends. Dividends are not guaranteed, but know enough about the company that the agent, the guy that's in my seat, can actually speak fluently a little bit about that company. So again, David, can you kindly provide an example of a product you were speaking about? That's it. Mutual company, whole life insurance policy, non-direct recognition type strategy, and with a company that pays their dividends. And if anyone's met with me, there's a lot of great insurance carriers left in the Northwestern Mutual, great company. Pac Life, great company. Ohio National, pretty good company. They demutualized a few months ago, and that's a story for another day. I'm happy to help anyone with this because it's what I do every day. Again, you can get the recording of this. Today's Tuesday. They're normally up on my YouTube channel, I believe, by Thursday. And then you can normally find them on my website. I may have been a little bit remiss in getting them up there recently, but the YouTube channel is at Brian Shey. Like it, hit the bell, you'll get notified, all that kind of good stuff. If there's other people out there that we all know different types of people, and they need to get this information, feel free to, I'm assuming you can forward the link to register for this webinar on a weekly basis and get them in. I know there's about 75 people that are registered. Some hit it every week, some come every other week, whatever it may be, but feel free to invite other people that you think need to understand this information. And then I would be remiss one other thing, because I mentioned it today, that if you're out there, I saw a post today on some social media platform that was talking about long-term care. In my humble opinion, I'm just going to say it, One America out of Indianapolis, Indiana, in my humble opinion, has the best long-term care policy in the United States of America. Pretty easy for me to say when I say they're the only company that I know of in the United States of America that will pay a lifetime income benefit, if you're under a claim. Most companies are 3 years, 5 years, 7 years. One America will pay a lifetime benefit to someone that is under claim. Number two, they put a husband and wife on one policy. Number three, you can use qualified money to fund the contract, and there's a lot of tax advantages for that. So that gets into a little bit of details, but if you're someone out there that has parents, grandparents, other people that you may know that need to understand or one of those values of retiring with dignity, and they need to look at a strategy like that, then that's the direction. Feel free to contact me. Happy to help you any way that I possibly can in that area. So do you set up the policy itself, whole life, or refer it? No, I do this every day of my life. This is my job. So I'm an independent guy. I run my own practice in Gainesville, Florida. Been here 25 years doing it. So no, I don't refer anything out to anybody. So no, I do all that myself. So Dexter, good question. And if you missed it, then we're going to talk. We're going to talk One America. They get 99% of all of the business that I do. And I don't know why I say 99, I probably just should say 100, but I'm an independent guy. It's not like I'm a captive dude with One America. Mike, for qualified funding, are you speaking about single premium immediate annuity 10 pay? What I'm talking about, that not necessarily, Mike. So let me answer that this way for the people out there. And I know it's 159. So One America has the ability. First of all, they invented and patented the asset-based long-term care policy that they write. Invented it and patented it about 32 years ago. I think the patent came up about 4 or 5 years ago, but there's still no other companies out there that have even tried to really emulate what One America's policy does. Can you use a single premium immediate annuity? Yes. And you and I may be talking about the same thing. What I'm saying is, if you took $200,000 in an IRA, a qualified IRA where you have to pay taxes, you can give that to One America, and then they drip off a premium for 10 years that adds up to a little bit of that. Now, they actually give you a 20% bonus on it. And then instead of somebody, like if you were to take 200 grand out of a traditional IRA and put it in an investment account or your bank account, well, you'd have to pay taxes on a $200,000 distribution. One America does it differently, where, yes, okay, we're talking about the same thing. So, okay, so they drip it off, and then you get a 1099 on an annual basis for the amount of the distribution, providing that you're not under claim. If you're under claim, then the premium's waived and they just send you the check. So if we're talking about the same thing, that's fine. Guys, with that said, I planned on going about 20 minutes today, and here we are at 2:01. So enjoyed being with you. Happy Tuesday. I will be back on next Tuesday. Going to run down to the Bahamas from Thursday to Monday, but we'll be back here on Tuesday. And again, if there's anything I can do for you, feel free to reach out to me through email or my website. Jump on my Calendly link, and you'll be on my calendar. Look forward to being with you. For anyone else that I'm working with, good to see you guys. Hopefully you got something out of today. And other than that, I'm out of here. See you guys next week. Take care. Have a great week. Bye.